Hello. In the previous video lesson, I introduced you the notion of current account. So in this video lesson, we then take a bit more detailed look at the balance of payments accounts, and I will take the practical example from the United States following the Krugman et al. Textbooks example. So here on this table, taken from the textbook and originally from the U.S. Department of Commerce, indicates the U.S. balance of payments account for 2009. So this is the current account that I previously defined as the difference of exports and imports. So we can then take a little bit more detailed look at what does exports in more precisely consist of. So of course we can distinguish between goods and services like discussed earlier, and then there is also a third item called income receipts, and this relates to the primary income. So there are, for example, dividends paid for the U.S. investors, so dividends received and interest payments received by the U.S. investors from their foreign assets. Then the imports also can be broken down to imports of goods and imports of services, and then in imports there is also income payments. So this is then interest and dividends paid from U.S. assets to the foreign investors who are holding these U.S. assets. So this kind of interest and dividend payments also are counted in the exports. So then there is, of course, also so-called net unilateral transfers. So this is then type of secondary income, and this would include, for example, gifts, pensions, and related taxes. So, for example, very often immigrant workers like to send some money back home to their family members in another country or extended family in their home country, and this of course might happen for Americans living abroad, but also for foreign nationals who are working in the USA and sending some payments to abroad. So pensions would be, for example, then if American retired person decides to move abroad after retirement and receive some pension payments from the US. So this kind of secondary income is also then taken into account in the current account. And the balance of current account is then calculated as the exports, item number 1, minus imports, item number 2, plus then this net unilateral transfers, which is then a smaller of these items. And in year 2009, then the balance of current account was minus 378 billion US dollars. So there was a current account deficit in that year. So I have talked about current account so far, but there's also another way of looking at. So current account looks at, for example, this kind of flows of goods and services. But then there's another way of considering, and this is called financial account, and this is then based on more based on assets. So here, item number 5 is the net U.S. acquisition of financial assets, excluding financial derivatives. So this is then includes, for example, this kind of private investments outside of the USA by American households. One important item here is official reserve assets. So official reserve assets refers to the assets held by the central banks for their monetary policy operations. So this 52.3 billion is then the US Federal Reserve's holding assets or acquisition of assets in other countries. Then item number 6 is the net US incurrence of liabilities. And so then this is then foreign individuals or companies or foreign central banks holding US assets. So notice here this in item number 6, this official reserve assets in the USA held by foreign central banks is fairly sizable, 450 billion US dollars. However, then other assets, so incurrence of liabilities of other assets is negative. So other than central banks, then individuals or firms were decreasing their US asset holdings in 2009. And remember, 2009 is of course like immediately after the financial crisis that occurred in the USA, or perhaps it was still kind of a crisis year, which can explain the quite sizable negative 144 billion US dollars in this item number 6. And then there is a financial derivatives is separately in the item number 6. And then this net financial flows is similarly to the current account. It is item number 5 minus item number 6 plus item number 7. So the financial account balance is then minus 216 billion US dollars. So in principle, when we think about this kind of bookkeeping, this kind of financial flow should be matching with this kind of current account. So if we have this physical trade of goods and services, then similar to this kind of current account deficit, we see that this item number 5, net US acquisition of financial assets, is smaller than the item number 6, this incurrence of liabilities. So both the financial account and the current account are negative. But I just go quickly back to the previous slide. So we saw earlier that the current account deficit was minus 378 billion US dollars. However, the financial account deficit is only minus 216 billion US dollars. So there is quite a sizable gap, and this is then if you compare this to financial account deficit and the current account deficit, then the difference is called net errors and omissions, and it is quite sizable, 162.5 billion US dollars. So interestingly, that this current account and financial account do not exactly match, and there are some explanations that, for example, if some goods were sold in December, but the payment is received in January, or other way around, then it can be that there is timing of this financial transactions, and when it is some kind of item is recorded in the trade statistics can be different. But still, this kind of 162.5 billion US dollar difference is quite a sizable. So that concludes my presentation of the balance of payments item. In the next video lesson, I will then compare Finland's balance of payment in more recent years. See you then.